Hello, everyone, and welcome. Thank you for joining us today. Without further ado, it is my pleasure to introduce to you Peter Neuwirth. He's the author of What's Your Future Worth and Money Mountaineering. Peter is an actuary specializing in retirement plan issues whose research has been published in professional journals such as the Journal of Deferred Compensation, Contingencies, and the Journal of Financial Planning. To our live viewers, please type any questions you may have into the chat box, and time permitting, we'll get to Q&A at the end of the presentation. With that all said, Peter, I'll hand the mic on over to you now. The floor's all yours.
Hey, well, thank you very much, and thank you to the Money Show for having me on. And as Charlotte says, I'm an actuary, and I've been an actuary since 1979. I actually happened into the profession as I was looking around after graduating from school with a math degree, and found that actuarial becoming an actuary would pay me to take math tests, which was something I was pretty good at. In any event, it's been a great career, and still going on. And I would love to talk to you about what an actuary is, why it's important, and how the actuarial perspective on retirement income strategy can be very, very useful. So for those of you who don't know what an actuary is, and I expect that most of you do, we are the professional that evaluates the current financial implications of future contingent events, contingencies like life, people dying, people living too long, people being disabled, et cetera, et cetera. And our philosophy is that we deal with what is, not with what we would like it to be. So, in fact, what actuaries do is deal with three components that are central to our lives and central to the world of financial planning and navigating through again, all the financial journeys that we go through in life, including and particularly the journey after retirement. So when it comes to financial wellness, we help you balance time, risk, and money. Now, as the image shows, we can help with one side of the equation, but the other side of the balance is what's inside you, your hopes, fears, desires, plans, and your situation, which, you know, no actuary can know exactly what's going on within you, but we can tell you how those three components combine and should be balanced against other things within you. So today, as I say, we, as a general rule, actuaries balance time, risk, and money. And today we're going to be talking about risk, because when it comes to retirement income strategies, I think this is where many people, I don't know, I wouldn't say get the wrong impression or go off the trail, but they don't focus enough on the risks associated with whatever income strategy you have developed for your retirement. So let's just get right into exactly what I'm talking about. You know, when I got into the business in again 1979, the paradigm, the model that we all learned was the three-legged stool. There was Social Security, there was guaranteed pensions that were usually provided by employers and by the company, defined benefit pensions, and then there was personal savings. And the model was that between those three legs, an individual could provide themselves or get provided a sustainable lifetime income and live happily in retirement. And for a long time that worked. But then there was this thing called 401ks that came around. And I remember when that happened. I mean, I was and this was in 1978, the government passed a law that changed what had been a section of the IRS code, which was dealing with what was called permitted disparity. And they moved that section of the code to 401L. And then they put in a brand new section called 401K, and where that provision would allow employees to defer money into an account tax-free and or tax deferred. The money would accumulate tax-free, and then it would come out. And this was a brand new way of providing retirement. Now, in 1981, the IRS issued regulations on how 401k should work. And I remember sitting in as a brand new actuarial student at Hewitt Associates in this training session where, and bear in mind, as an actuary, we used to do defined benefit valuation. So we would calculate the numbers for guaranteed pensions. So yet we were having to learn about this new type of retirement plan, which really didn't seem to have any actuarial components. But the senior actuary running that session said, this is going to change your life. This is going to be big. And it really was. We all know what happened after 1981. Company after company after company put in 401k plans. And then soon into the 90s, those plans, they did exactly what they were intended to do. They gave employees control of the dollars that the companies were providing for retirement. They could manage their investments. They could have access to the money, all the things that employees wanted. So it was a win-win situation. Companies were happy because they had become more efficient in the delivery of their retirement resources. Employees were happy because they had control and access to the money, but there were unintended consequences. And that's what we're going to talk about today, because throughout the 90s and the early 2000s and continuing up until just fairly recently, companies got out of the business of providing defined benefit pensions and just started, and everybody began having to rely on their 401k. So that savings leg has gotten bigger because it's not just personal savings, it's the 401k. And Social Security's gotten a little shakier. So the point is that three-legged stool is no longer stable. So what are we faced with now? Well, we're faced with a generation of employees having to retire where they have to find a way to live on the assets that they've accumulated throughout their career in their 401k and savings plans and maybe their IRAs, as well as perhaps some Social Security. So the question is, what do you do? And so investment advisors have been thinking about this to some degree, but they were focusing mostly on the investment side of things and how you accumulate enough to retire. And what was enough? Well, in 1994, William Bagan came up with a 4% rule that says, when you retire, if you draw down 4% of what's in your account, and you keep drawing down 4%, you're going to be okay based on average expenses and returns and inflation and a whole bunch of factors. But unfortunately, that's not working. And it doesn't work. And it doesn't work because of some aspects of decumulation as opposed to accumulation that we're going to talk about. So, one more point I would make about this is that when it comes to living on your assets in retirement, you have to recognize you have not just, there's another big asset that is not generally considered, which is your home equity, the house. Most people own a house and the value of that house is significant. So when you look at all of your assets at retirement and how are you going to live on them, it's appropriate, I believe, to not just look at your 401k and savings, but also to look at your home equity. So accumulation versus decumulation. Why are they so different? Well, again, one of the key differences, it's pretty obvious, is during accumulation, you're just building up assets. But decumulation, your assets are also continuing to be invested and continuing to grow, hopefully, but you have to draw them down. So you're pulling money out of your assets during the decumulation phase. The other less obvious difference between the accumulation and the decumulation phase is that during the accumulation, you really are not thinking about the end. I mean, really, you're thinking about, will I have enough when we actually retire? But once you're in the retirement side, now you have to think about what is the end point of decumulation. During accumulation, you can choose when to retire. You can make a choice and decide on when that accumulation phase will end. But you don't get to choose when your decumulation phase will end, because that is determined by life contingencies. And it's governed by variables that are not easily calculable on an individual basis, although plenty of actuaries have calculated averages and life expectancies, and you can use that as a rough guide, but not as a specific guide for yourself without some real hard thinking. So, as an actuary, we think about risk, and we think about how to manage risk, what the risks are, how to evaluate them, and what to do about them. And when as an actuary, we look at retirement planning, again, we look at it in two phases, accumulation and decumulation. And there are basically two risks that you have to experience and navigate through when you're accumulating assets. The first is inflation and investment, risk return, and recognizing that, it's all well and good to put your money into treasuries and get a nice 3, 4, 5% return, but that might not keep pace with inflation. And so you've got to think about putting money into equities and so forth. And then you've got specific liquidity risk. If you're going to put money into something that's not so liquid, will you have to sell at the wrong time? So you got to consider those two risks during the accumulation phase. But there are 4 other risks that are either not really there or very minor during accumulation that are prominent during decumulation. The first is longevity risk. That is the risk of living too long, the risk of outliving your assets. Now, that is to some degree, I guess, present in the accumulation phase because you might die before you retire. But it's really it's present in the decumulation phase most prominently. There's also tax expense risk. Taxes are something that's considered by the investment professionals during the accumulation phase to a great degree, but it's less manageable in retirement, and that's why you don't know what that expense is. You don't know if they're going to change the tax rules on you as you're drawing it down. Fifth is sequence of return, which is unique to decumulation. This is the risk that you're going to have to draw money out when the market is down. And actuaries and others have shown that if, depending on the pattern of returns that you get through retirement, you could have a very healthy and happy retirement, or you could have a very meager retirement. And then finally, there's spike expense risk. Spike expense risk is the possibility that you'll have a unreasonable and unexpected spike in your expenses. Again, back to what I said earlier, historically, drawdown or retirement income strategies have been based on the notion that your expenses are constant or budgetable or predictable through retirement. That's not the case. They're very unpredictable, and that's a problem. But let's talk about longevity risk for a second. Longevity risk is, again, the risk that you're going to outlive your assets. You're going to run out of money before you die. And the problem with longevity risk in retirement is it rears its ugly head at exactly the wrong time. It's after you have lived past the time you expected to die or your life expectancy, and you're still healthy. And let's say you thought you had budgeted to living to 85, and here you are at 82 and you're still healthy and kicking. What are you going to do for the next 5, 10, 15 years? And that's where you've got to take some steps. And there is a possibility, there are things you can do. You can purchase pure longevity insurance. That's a deferred annuity that you buy maybe when you're 65 that begins paying out when you're 85 and for the rest of your life. You can maintain a buffer asset, which is potentially more practical, but as with most life contingencies, you're better off, if you've got a risk that you want to insure, you're better off buying insurance for it than trying to manage it yourself. Because if you're going to use a buffer asset, you've got to maintain that value all the way through its maintenance until you actually need it, which is not so easy. Tax expense risk, again, it's an important consideration for all phases of managing money. And like I said, during the accumulation phase, you're going to get a lot of advice as to how to shelter income or minimize the taxes. After retirement, you're just drawing down money that generally is taxable, and you're kind of just subject to the whims and the vagaries of the tax code and the tax law. The one thing you can do that, again, research is still ongoing on this, is you can convert your IRA to a Roth, in which case then you've sort of taken tax risk off the table, at least with respect to the IRA piece of it. Sequence of return risks, again, is a pretty nasty one as well. And it comes from the volatility of the portfolio, from which you're distributing assets. And if you're having to draw down assets at a time when the market is down, that reduces your base to a point where it's going to be very, very hard to come back. So drawing down assets while markets are volatile is a very, very tricky and hard risk to handle. Now, fortunately, this is an area where actuaries and others have developed some pretty effective techniques for for dealing with it. But again, spike expense risk, that's the one that is very, very tough, because it's almost never been considered in any of the literature prior to this. And people are starting to think about it now, but it's been a long time coming, because all of the strategies that have been developed kind of assume some kind of smooth pattern of expenses, or at least predictable. Maybe they start high when you're going out traveling, they reduce when you're sort of staying at home, and then they pop up again when medical costs come in. But as a practical matter, that's really not the way it works. You could have a health emergency in the middle of your retirement. You could have a family emergency. You could have your house repair that is required. All kinds of things can happen to you. And so this is one where more research is needed. So how do you mitigate these risks? Well, again, actuaries and others have developed pretty effective techniques for mitigating sequence of return risks. And this one is an illustration of how what you can do is you can coordinate your drawing down from your home equity when markets are down, and your portfolio when markets are up. And this, my collaborator Barry Sachs and I have written a couple of papers on this, and it is very effective. What this graph shows is that if you use a coordinated strategy, you will have a 90% chance of, under these circumstances, this is a guy with a $1.2 million set of assets made up of a portfolio and a house worth a few $100,000. And if you take out a reverse mortgage and draw down from the home equity when markets are down, and take from the portfolio when markets are up, you will be on the blue line. If you just wait and continue to take from your portfolio, and then at the very end, draw from your house, you're in the red line. And there you have a 60% chance of outliving of only a 60% chance of still having money left when you're after 30 years. It's a scary set of graphs, but but again, it can be mitigated. Now, a lot of times people will say, well, what happens if you take that strategy and end up with at the end, you lose your house, for example. Well, that's a criticism that has been leveled against reverse mortgages for years and years, and it actually is not as much a risk as people think, because the government actually guarantees that you'll never lose your house if you take out a reverse mortgage. But more to the point, what this graph shows is if you take that coordinated approach that I just mentioned, you will end up with more portfolio and less home equity later in your retirement. That is what you will need to handle these other risks, like spike expense risk and longevity risk. So I'm going to wrap up here and leave a couple of few minutes for questions. But point is that decumulation is one of the most important retirement planning challenges facing individuals and advisors who are trying to assist people with their financial plans. Again, for many years, the decumulation was left to the investment world and banks and financial planners who were most familiar with how to invest and accumulate assets. we need a new set of skills and we need a new set of techniques for dealing with the risks, because decumulation is fundamentally a risk mitigation problem. And the actuarial perspective needs to be brought to bear, along with traditional investment analysis. The other message I would leave you with is that as much progress as has been made, and as some of the techniques are available, there's a lot of research still to be done. So with that, I'm just going to open it up for what I guess is that we have a few minutes of questions. And Charlotte, do we have any questions?
We do have a couple of questions just coming in now, if you're ready.
Sure.
All right. So first one from Sylvia. She asked it just a couple minutes ago. The question I have is, can you justify the interest expenses and carrying cost with respect to reversed mortgage or HE drawdown?
Sure. Well, that is an objection that is often raised about reverse mortgages. But what has to be considered is that a reverse mortgage, or particularly a home equity conversion credit line, is a very unique asset class. You do not have to pay interest. Unlike a traditional HELOC or line of credit where you have to actually pay back the loan, when you take out a reverse mortgage or set up a credit line, you can draw on that credit line and not pay interest. All that interest accrues and is only payable if you move out of the house or after you die. And again, the government guarantees that all that accumulated interest will never cause you to have to pay more than the house is worth. So between the government guarantees and the fact that the interest is not payable during the decumulation phase, carrying costs are really not an issue for a retirement income strategy.
Thank you. We have another question, this one from Stephanie. Stephanie says, my husband and I are going on 76. We have IRAs, but not Roth IRAs. Do you think we're too old to switch?
Well, that is a very, very good question. And it's not a question that I am able to answer because, much of the work that I've been doing in this area, I've been doing in collaboration with a guy named Barry Sachs, who actually was the inventor of that coordinated strategy. And then he and I started working together as to how to actualize it. And Barry is not just, he used to be a quantum mechanical physicist. He's a physics PhD, but he became a tax lawyer and a really, really good one. And his expertise is in, again, home equity and the tax implications of using reverse mortgages and Roth conversions. He is an expert in that, and he's got a paper that's coming out on Roth conversions. I think he is generally positive that Roth conversions can work late into retirement. So I can't give you a definitive answer, but I guess I would say look for Barry's publications. And in the meantime, if you send me an email I will be happy to pass the question on to Barry and see what he says.
Thank you, Peter. Another question we have from Lou just now is asking, can you pay back what you've drawn from a reverse mortgage and close out the loan? And at what terms?
Yes, the answer is you can pay it back. You can pay back what you owe anytime you want. It's actually wonderful. It's a credit line that you can draw on and pay back. But again, interest is accruing, so the debt is accumulating. But the credit line itself actually grows over time. So it's a very unique asset class. And if you're interested in reverse mortgages, I would direct you to some of the other stuff on my site and stuff that Barry and my collaborators have done. So And I think, is that it? I mean, I'm looking at the time, Charlotte, so you tell me if we've got
Yeah,
time or if that's
it
it.
looks like we are just about out of time. We have a few more questions, but maybe we can squeeze just this last one in from Matt asking, could you elaborate on the annuity option that you mentioned for age 65 to 85?
Sure. So this is, again, what I would call pure longevity insurance. And it is in the form of you provide, let's say, I mean, there's lots of insurance companies that sell them, as well as I think Fidelity was selling one, and some of the other um, big investment houses. And you provide a lump sum to the insurance company, and then they will guarantee and begin payment to you at age 85, let's say 20 years from now. So they will take care of accumulating the assets. They'll pool it with all the other 65-year-olds who have bought those things, and some of them will have died, and then they'll use that money to pay you out a life annuity beginning at 85. And the prices are surprisingly reasonable, and better than you could get by investing the money yourself and then trying to draw it down, unless you're really, really good at investing money.
All right, thank you so much, Peter, for a fantastic presentation and for answering all of those questions.
Well, thank you. And I really, really appreciate the opportunity. And again, anybody who wants to, reach me, either contact Hope or, contact me directly. My email is my website is peterneuwirth.com. My email is peteneuwirth@gmail.com. So feel free to email me, and I respond to them all.
Right, fantastic. And to those of you in our audience, I will just put the title of the website in here for you so that you can go ahead and copy and paste that in your browser if you'd like to check it out. And that does conclude our time for this session. So thank you all once again for joining us today. It's always such a pleasure to have you. I hope everyone enjoys the rest of your day, and be sure to stay tuned as we do have a lot more in store for you. All right, bye-bye.